Hello, my name is Shoaib Akhtar. I'm a senior investment analyst by trade. I've worked in the industry for over a decade. Today, I would like to talk about what are the key reasons or red flags or warning signs to reassess a fund manager or to consider firing a fund manager. We are all at some stage of our life, we have also invested in funds either directly or through work, pension schemes, etc. So today I'm going to show you what are the 10 red flags or warning signs you should consider. Review your existing exposure to the fund manager. I use principled approach, and which is an acronym which I use. There are 10 various letters, 10 elements which are taken into account when I'm making a decision around whether to keep, maintain or fire a fund manager. A, starting with P, persistent underperformance. If a fund manager continues to underperform persistently during various market cycles, then you should consider whether to carry on paying that active management fees or look elsewhere. So now let me explain what do I mean by persistent underperformance. I'm not talking about underperformance in one calendar year or in one quarter. I am talking about underperformance during various market cycles. If a value fund manager is underperforming during a value rally, then you need to check what are the reasons. Is the fund manager underperforming due to stock selection, or are there any other areas? So performance. So look at the performance across various interest rate regimes, across various interest rate cycles, at least over the last 5 years, to give them the benefit of the doubt. The second which I use is R, risk management, poor risk management. If there is evidence of deviation or there is evidence of poor risk management by the fund manager or managers, then that is another reason to consider firing them. What do I mean by that? If, for instance, the stated investment process says that we cannot take more than 10% deviation, or we can't deviate more than 10% from a sector, from the benchmark. For instance, if it's a UK fund manager and they are comparing their performance to FTSE All-Share, and within the investment prospectus document it says I can't deviate more than 10% from a certain FTSE sector, but if there is an evidence of that deviation, that is called poor risk management. They are not managing the risk properly. So that is a warning sign to consider replacing the manager. And the next one is PRI, interest misalignment. What do I mean by that? I prefer investing my money in funds where the fund manager has skin in the game. What do I mean by that? Where the managers tend to invest a portion or maybe bulk of their bonuses within the fund, where they have some of their existing pensions invested in the fund, which means their interest is aligned with the underlying investors. It is quite important to investigate, to find out whether the fund managers have skin in the game. That is quite important. And it is also important to assess this on a regular basis because it can change, right? So interest misalignment is a red flag. The next one is N, named manager changes. Most fund managers, most funds, they have star managers or senior or the lead fund managers who were responsible for putting the fund together, who were the main artifact of the fund, who started the fund, or who have been associated with the fund since the very inception of the fund. So they laid the foundation, they put together the investment process, etc. If the lead fund manager leaves, that's a big red flag, because you don't know how the incoming or the new manager is going to take that fund forward. Even if there is a promotion internally after the retirement of the lead fund manager, rather than abrupt departure, you still need to carry out full due diligence to make sure you are comfortable with the new person, if that makes sense. So PRINC, capacity issues. To give you if a UK smaller companies fund becomes too big because of a lot of interest from investors, then they may not have the same opportunity set or the same number of alpha generation levers within the portfolio. Because if a 300 million fund buys a 5% holding, in a 100 million market cap fund, that represents a very small portion of their overall assets. But if a 1 billion fund has to buy 3%, that would constitute quite a bit of money. That would equate to 30 million. So 30 million holding by a 1 billion fund, which is only 3% of their total assets, but that 30 million equals 30% of the total market cap of that 100 million market cap of that stock, which means you own more than 30% of the total market cap. Most fund managers won't be comfortable doing that, and there are rules and legislations within the UK and other countries around that. So make sure the fund has surplus capacity to carry on managing the mandate in an efficient manner. So C, capacity. So PRINC, another I, investment objective. If you are an investor, your investment objective suddenly changes. You are no longer looking to buy a house. You are now preparing for your retirement, which means your investment horizon has changed. So you need to check whether the certain fund still remains appropriate for you or not. So investment objective, any shift in the investment objective of the investor, that is another consideration to whether to maintain or fire the fund manager. So PRINCI. Next is P, process change. So if the fund manager's process has changed, that means they have deviated from the stated investment process. To give you an example, let's say this is a UK equity income fund, and they originally were targeting income 10% in excess of FTSE All Share or any benchmark, they sort of tend to compare themselves to. If they suddenly drop the requirement to generate excess income, beyond the benchmark or in excess of the benchmark, that's a clear case of deviation from the investment process. That's a clear case of not adhering to the stated investment policy. So that is quite important and a big red flag. So for institutional investors or people who have spent decades in the market, any clear evidence of deviation from the stated investment process or investment philosophy is a big red flag and should be a cause for concern. Okay, so PRINCIP, L, liquidity. If a fund suddenly becomes illiquid, what do I mean by that? Illiquidity means it is difficult or harder to sell the underlying investments, particularly during a difficult market period. So a UK large cap fund, for instance, is supposed to have ample liquidity. You shouldn't be struggling to sell those holdings, whether the markets are under normal conditions or stress conditions, because large cap funds, their bulk of that money is invested into the FTSE All Share, some of the biggest companies in the UK. You should ordinarily be able to liquidate the portfolio more than 99%, in a single day. But if a large cap fund suddenly becomes illiquid, i.e. they suddenly starts filling up the portfolio from the bottom of the market, in terms of having micro cap stocks or smaller companies funds, a lot of them, and some of them are difficult to sell, that is another warning sign for you to consider. So liquidity is very important. So principal. Next is principled E, excessive charges. If your fund manager suddenly decides to increase their fees, that should be a cause for concern. Even if they don't increase their fees, but there are cheaper, better alternatives out there, then you can still consider looking elsewhere, as long as you can find an equally or a better product, but with cheaper fees, because the cost adds up over the long term. And D, style drift. This is also very important. If you have a value manager or a growth manager, suddenly trying to fill up the portfolio with value stocks, I'll explain the difference shortly, then you should be considering whether you should be sticking with them or looking elsewhere. So what's the difference between growth stocks and value stocks? A growth stock is a company where cash flow from the company is far out into the future, i.e. company doesn't pay much dividends or income. They are more worried about growing their company base, growing their branches, growing their capital base, and they are all about expansion. Value stocks, on the other hand, are defensive in a sense that the bulk of their profit gets returned to the shareholder in the form of dividends or share buybacks. So they tend to be defensive, sort of more cyclical. So if a value fund manager or if a growth fund manager suddenly starts loading up the portfolio with value stocks, that is a clear case of style drift, because markets go through various cycles. Over the last 4 calendar years to the end of 2025, in Europe, value stocks have been outperforming growth stocks. Okay, but the 5 years prior to that, growth stocks consecutively outperformed value stocks. So if a value manager suddenly believes that I may lose my mandate, I may lose my clients, I may lose these asset management fees which I am getting, by keeping or managing this money, and they drift from the stated investment style or investment mandate, and then they load up the portfolio with momentum stocks or the style which is currently in favor, which is against their stated investment philosophy, that is a clear case of style drift. So then you should consider firing them or have a serious consideration around the continued suitability of a fund manager. So this is the principled approach which I use when considering whether I should stick with a fund manager or whether I should be looking elsewhere. I have seen some investors, they consider replacing the fund managers after just 1 year or sometime even a quarter. A manager had a bad quarter, they would start looking elsewhere. Serious long-term disciplined investors don't think like that. They look at the long term. They look for the evidence around whether the fund genuinely underperformed because it is operating in a difficult market environment which doesn't favor its style, or whether there have been some deviation or errors made by the fund managers. Genuine poor stock selection. Poor stock selection is also forgivable if it is not too frequent. If too much poor stock selection is dotted around all over the place, then you should look elsewhere, because the job of the active fund manager is to generate alpha, excess return over the long term for the investors, and this is exactly why they charge higher fees. So if they are not doing their job, and if there are good reasons that they should be outperforming or doing better than the market in a certain environment, then you should definitely be looking elsewhere. If this video has helped you better understand how institutionals or professionals go about retaining or firing their fund managers, please feel free to subscribe, and I'll see you in the next video. All the best.